Indian IT ended the last financial year on a strong note. Almost all companies reported healthy numbers in the fourth quarter, but that's not according to the traditional parameters as companies move away from older verticals like system maintenance to digital services. It's only fair that one keeps the new baseline in mind. Agam Vakil is here to tell us what are the 5 things that one should watch out for from IT firms when they start coming out with the first quarter numbers in July. Agam, morning.
Good morning, Neeraj. Well, the themes that emerged in the last financial year will now become prominent. And of course, right at the top, we have the digital services theme. We do know that we've seen some staggering growth numbers for a lot of these companies, something like about a 30 to 40% growth for the likes of TCS and Infosys in terms of digital services, which now comprise of, 30% of the consolidated revenues. Many analysts are now of the opinion that digital services will now become mainstream. Legacy takes a backseat, which it always has over the past few years. But now a lot of these technologies which were in, I would say some sort of gestation period now will emerge and will drive growth going forward. And based on that, what we are looking at is, the expectation of as much as 30 to 35% growth in digital services, even in FY20, which means a significant amount of and an incremental amount of contribution from these services. The next one is perhaps a little bit of a concerning one, and that's the your growth from banking financial services vertical. What we've seen is some amount of volatility, and even though FY19 was very steady for the top 5 companies in terms of growth, there could very well be some more volatility, and it's not because of the companies themselves, but largely because of the external environment, and especially in Europe, because there has been a little bit of slowdown. While US has been very steady, there has also been a little bit of delay in decision making. Of course, we must remember that we've seen a lot of volatility in capital markets, as well as the fact that the interest rates, which have been, which are once again likely to be cut as per expectations, and that may not augur well for the banking industry as a whole, and that may in effect have an adverse impact on the industry. But that's a key watchable here. Moving on to the change in business spends. Now, this is a lot of analysts, again, and of course one of them was from Parag Gupta, Morgan Stanley, as he was saying that there will be more and more expenditure from clients towards change in business at the expense of run the business. So the difference, of course, is that run the business is basically in your systems in continuity, whereas change the business is your investments in new systems, that may actually land up literally changing the business and the way you're functioning. And you will see more and more allocations there. According to JP Morgan, this ratio stood at around 50-50, pardon me. Yeah, it is now at 50-50 as against 60% towards run the business in the previous year. Moreover, moving on, we're also talking about Europe. A little bit of volatility expected there as well, and it does contribute to as much as 20% of consolidated revenues for the top 5 companies, so it certainly remains a very crucial geography, and we have seen a lot of uncertainty. Let's not forget Brexit, that also plays out, and of course the 5G rollout has been very, very slow in Europe, despite the fact that there were a lot of expectations. So we do have a lot of exposure for the likes of Tech Mahindra, and of course in terms of banking and insurance and financial, of course the likes of Wipro, HCL Technologies, along with Infosys as well. And finally, a much talked about subject, that is the margins, essentially on the fact that we have seen elevated people's costs. In fact, over the last few weeks, it's almost every day that there is one paper or another which is talking about elevated people's costs, and that has been playing out since the 3rd quarter of FY19 through the 4th quarter and possibly even the 1st quarter too. And we must remember that local hires, especially in the US and Europe, they are 20 to 25 to 30%. They cost 25 to 30% much more than as compared to Indians on H-1B visa. So again, that may very well play out this time around. We've also seen a very large spike in subcontractor costs, and there are no signs of those costs being coming down, so that may also work against margins. But all in all, mixed cues coming in, mixed expectations, and many of these factors may play against the top 5 IT companies. Many of these factors may play for.